if you think about market action in the context of historical bear markets, what we're seeing right now is not unusual. If you go back to 2008, from September to December, we saw 6 rallies between 9 and 19%. So the fact that we rallied last week as much as we did, it's typical of how oversold we were prior to that. And actually, we ended up with the second best 5-day stretch in history. And I went back just to see how markets typically respond after stretches like that over the next 3 months, just to get an idea of where we might be headed. So looking at the 10 best 5-day stretches over history, the news is not great over the next 3 months. The market's only positive 50% of the time. That compares to 66% of the time of typical 3-month periods. And the average return is actually negative 1% versus positive 2.2% for all 3-month periods. So again, what we're seeing right now is not all that unusual in the context of a bear market. And to the point that we were just making about auto sales and the issues with energy and just general economic data overall, I think we're going to have to continue to digest numbers like that, and that's going to make it really hard for the market to rally sustainably over the next couple of months.
Yeah, that's sort of the thing that's been on my mind as these numbers come out. Rick Santelli can dismiss them, but they're going to be there nonetheless. Whether how accurate they are and how lasting they are is a matter for debate, and Rick is right to raise it. But we're also going to start seeing an awful lot of corporate numbers, just like Toyota's, that paint a very, very bleak picture. So it wouldn't surprise you, would it, if we test the lows from last Monday?
No, it wouldn't at all. And I think investors understand that economic data is going to contract, but I don't know that we fully understand the magnitude of that contraction. And to Rick's point, I think we're going to need to dive into the data a little bit more. I look at the manufacturing PMI number that we got this morning. On face value, it actually didn't look that bad. It was actually slightly above expectations in contraction, but not awful. But if you look under the surface, there are some nuances there that are important to understand. So supplier deliveries, when they slow down, that's typically a sign of high demand in a growing economy. Supplier deliveries have slowed down dramatically, but it's because of the issues with the virus. And that reading was 65. So that actually propped up the index, but actually for a bad reason. If you look at new orders, that fell 8 points to 42, the largest decline that we've seen in over 10 years. That's more indicative of the type of environment that we're looking at. So not only is the data important, right, but trying to parse exactly what's going on under the surface is going to give us a better idea of the true magnitude of the slowdown we're facing.